In my video that I posted on my website, blackbeardog.com, I start off by saying that when it comes to Forex trading, you've been lied to. It is not per se that you've been lied to, more so that you haven't been told the entire truth. This is Load with Black Bear Dog Trading, and I want to talk about the reason why so many retail traders still don't make it in Forex trading or any other trading for that matter, be it stocks, bonds, commodities, futures, cryptos, whatever it is you trade. There's a reason for it. And the reason has partially to do with the fact that you don't know the whole truth about trading. There are two factors that determine trading, and they are called momentum and volatility. Momentum determines the strength of the trend, how strong price moves up or down, and volatility means how much price moves distance-wise over a certain period. These two combined make up the entire trading. It is momentum and volatility combined that determine a strong market, a weak market, consolidated price, breakout, retracement, whatever have you. Most retail traders try to take advantage of when certain conditions happen in these markets, whatever it is you trade again, and they want to either focus on support and resistance levels and trade breakouts or retracements. Others wait for a trend to start, whether it's up or down, and after a certain amount of pips, price moving in favor of that trend direction, they'll head into a trade. Whatever the strategies are, it's not the strategies that are the problems. It is components of the strategies that really cause so many traders to basically lose their shirts. And that is the part that you haven't been told. You see, there are two types of trading. I'm not talking about the type of trader, that's different. I'm talking about trading itself. There are two types. The first type is fixed trading, and the second type is dynamically trading. Fixed trading is what most retail traders do. Everything you use in your trading, all your main components that make up your strategy are fixed. For example, your lot size is calculated on a fixed risk percentage. Your stop loss is set at a fixed number of pips. Your take profit is set at a fixed number of pips. Dynamically trading, on the other hand, is done in a way where all these components are automatically adjusted to go with the fluctuation of the market. That's the reason why professional traders almost always are dynamic traders, not fixed traders. A fixed trading system, which is commonly used by retail traders, does not adapt to market changes as it should. And because of that, many times you get stumped out because your stop loss is not enough pips away from your entry point. During a quiet time, like when there is no volatility, market is sideways and movements are very little, using the same number of pips for a stop loss has the opposite effect. You may have your gap too wide and now you're actually risking too much. You may also use a far too big lot size during quiet markets and a not big enough lot size during volatile markets when there is really market movement. The fixed trading method is the result of why so many retail traders don't make it. And the only way that you stand any chance in becoming a successful trader, and again, it doesn't matter the asset you trade, it applies to all of them. It applies to stocks, it applies to bonds, cryptos, as I mentioned already, and it applies to Forex trading. You must adapt a dynamic trading method. A trading method where all your main components have a base level, but these base levels get adjusted automatically accordingly to how the market is reacting, what the market is doing. This is particularly important when there is a sudden news. For example, just 2 weeks ago, there was the announcement of the trades that were going to be imposed, and the euro all of a sudden just shot up. Um, to take advantage of these kind of movements, or the reverse, where there is news that is devastating, and now your position goes completely the opposite direction of the position that you originally took. Buy converts into a sell, or sell converts into a buy. Basically, you're ending up with a losing trade because, again, the main components of your trade are fixed. What are the main components of your trading strategy? Number one, their lot size. Number two, it is your profit ratio. Number three, your stop loss. Number four, it's your spread. And number five, it's your support and resistance levels. And all of these components need to automatically adjust, or at very least as quickly as possible, in order to take advantage of a market, depending, regardless, of how it moves. Picture for a second that you are a professional trader. You work for a bank, you work for a hedge fund, you work for whatever institutional financial institution out there, and you work on fixed numbers. Your stop loss is 100 pips. Again, example, of course, no matter what. I don't think you'll be perceived well by the powers at B, because you will have many, many losing trades, since 100 pips is basically set in stone. It doesn't move, it doesn't budge. It's 100 pips and that's it, no matter what the market does. Or, on the other hand, equally as bad, you have a profit ratio of 3 to 1. Three profits for every amount of risk you take. That too is fixed, set in stone. And suddenly, for whatever reason, there is a breakout happening. And while you were on the right side of the trade, you only got to take three partial profits, three parts of profits. While had you an adaptable profit ratio, you might have had 6, 7, whatever. I just say something as an example, but this is how it works. And you need to really seriously consider trading dynamically if you want to turn Forex trading into a long-term and, above all, profitable career, meaning making money. Of course, brokers don't want you to do that, because the fact of the matter is, if you do, they make a lot less money. And the name of the game, after all, is for the brokers to make money. They absolutely love it when retail traders go bust. Sad to say, but that's the nature of the beast. So you need to be on the dynamic side, no longer the fixed side. So I told you I was going to give you a plan. Here's the plan. My next video, I'm going to start talking in depth about what dynamic trading is, all the components that make part of the dynamic trading, how you need to adjust them in order to take advantage of market conditions, what settings you should be using, etc., etc. The next step in the plan is that I'm going to actually show you a trade of with fixed components where stop loss, lot size, partial profit are all fixed like the way most retail traders trade now, versus an actual dynamic trade where all these components are flexible and update or adjust with market moves. And thirdly, I am going to give you the tools, the actual tools to do this so you can do this automated. Because while you can trade dynamically, quote unquote, manually, meaning that you kind of have to keep an eye on the news, you have to keep an eye on fluctuating economies, and then be ready to immediately recalculate where you're at with where your stop loss should be based on market condition, where your profit level should be, etc., etc. You need to recalculate that. You need to be very good at it. You need to be accurate, and then immediately implement it. Obviously, that is, while possible, very tedious and not at all the recommended way of going for reasons I'm sure I don't need to explain. So I'm going to give you the tools to do this on autopilot, where based on conditions that you enter, the main components of the strategy will automatically take care of it for you based on whatever market conditions are happening at the moment. And last but not least, I'm actually going to give you my trading strategy, which is the MACCI that you know by now. If you've been following me from the beginning, then you know that my absolutely preferred trading method is the MACCI, which is what I've been using for more than 10 years now. And I'm going to give, and while I gave you an MACCI bot that allows you to trade, it is very important you understand that this bot that I gave you way back when is based on fixed components. You're going to get my real version, my dynamic version that will no longer use fixed components, but components that dynamically update and change and modify depending on market volatility and momentum. So this is the plan. So I'll repeat. I'm going to in-depth explain what dynamic trading is. I'm going to show you with real life examples. I'm going to give you all the tools that you need for that, including my actual trading strategy as an EA. And I'm also going to give you, last but not least, once you got the EA, you obviously need to know what all the options are in the user menu, and you're going to get a booklet that explains all that in detail. You're actually also going to get preset files which have optimized configurations already based for the currency pair you wish to trade. I'll be frank and upfront. I only trade 5 currency pairs. You know that by now too. The Euro USD, the USD JPY, the USD CAD, the Australian USD, and the British Pound JPY. And for those 5 pairs, I already have preset optimized settings included. But I'm jumping a little bit ahead. When we get there, I will show you all that, and then you can become a dynamic trader the way you're supposed to be trading. Now, disclaimer here. Dynamic trader doesn't mean, therefore, that every trade you take will be a profit. Obviously not. However, your ratio of profit will most definitely increase versus fixed. There will be less stumping out. There will be less account blowups. There will be better profit ratio. There will be better risk management. There will be equally better lot sizes based on the spread that is currently going, because you may or may not have noticed that the spreads lately are quite high, thanks in part to the tariff war that's going on, and particularly with the US and China, being that China exports basically around the world, and all the up and coming countries who now cannot export to China or import from China all the products that they need. There is basically scarcity of wanting to trade those particular currencies, and so people have jumped on what they call safe haven currencies, being the USD, the JPY, and also to a little lesser, but nonetheless, the Euro USD. That, of course, resulted in much higher demand for these three currencies, and therefore a higher spread. A higher spread operating on a fixed strategy means that you must have bigger lot sizes to make equal amount of money. You must have probably bigger stop losses to make taking more risk to make equal amounts of money, because don't forget, the moment you enter a position in Forex, you first have to cover the spread before you start getting into profit. And when the spread is larger, of course, you have to cover more ground to make up until you are in profit. It makes sense, it all links together. So, enough said. Stay tuned for my next video, when I'll start with the first step of the plan by explaining to you in depth what dynamic trading is. And until then, take care and God bless.